You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. It's time once again for the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all the fascinating option strategies and developments in the world of options for you, the busy financial advisor and asset manager. Maybe you don't have time, probably you don't have time, really, to monitor all of the latest developments and strategies and news from the world of options. So don't worry, we're here to do it for you. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-exciting, ever-expanding Options Insider Radio Network. 15 programs on the old network now, including, of course, our latest editions, the Business Show, and TWIFO. This Week in Futures Options, as the name implies, that's a program where we break down all the latest developments and all the cool stuff happening on the commodity side of the fence. So the crude oil, the gold, the silver, the soybeans, and all the other fun stuff in there, as well as some financial futures if you can find some time as well. So you can check that out, as well as wherever you can find your favorite back archived episodes of this fine program, The Advisor's Option. The easiest place to do that, of course, the mothership, the flagship, theoptionsinsider.com. And while you're there, of course, make sure you click on, got a lot of great articles up there too, not just all radio. We do a lot of radio, but we're not all radio all the time here. We do a lot of breaking news from the world of options, education, analysis, a lot of unusual activity. Check all that out over there on the website, theoptionsinsider.com. And of course, you can always find our radio, iTunes, TuneIn, Stitcher. Just added iHeartRadio a couple of days ago. So yet a new addition, in addition to the Google Play podcast we added a few months ago. So whenever a new outlet comes online, we make sure our content is available for you there, as well as via our mobile app, available via iTunes, Android Play, Google Play, I should say, and of course, the beloved Fire OS. And joining me on the old program, let's go in reverse order. I was talking about TWIFO earlier. You may recognize his voice. He's my co-host there on the old TWIFO program, but he's coming on to this program today because we're stepping into his neck of the woods. He is Nick Howard, the founder and CEO of Bantix Technologies and the creator of a little platform we like to use over there called Quick Strike. Nick, welcome for the first time to the Advisor's Option program.
Hey, thanks again for having me. Feels like I'm on the radio with you all the time these days.
You're become quite the fixture on the network. Well, it didn't seem right. We're talking futures. I let the cat out of the bag there. A little surprise early there, but we're talking futures options today, so it didn't seem right to get into it without at least having you here on the old panel today. And we are also joined all the way from scenic and lovely Puerto Rico by Chris Hausman, the portfolio and chief technical strategist over there at Swan Global Investments. Chris, welcome back to the program, and how are things in lovely and scenic Puerto Rico?
Hey, Mark, thanks for having me. Still sunny here, like always, so glad to be on again.
Well, guess you can't complain. That's why you moved down there, right? You wanted a little bit of sun. You don't move to Puerto Rico for the skiing.
No, that's for sure.
And last but not least, he hasn't been on in a while, but he's joining us yet again. It's kind of fun to have a Federal Holiday Mike, a.k.a. Auntie Mike, a.k.a. good old Mike Kavanaugh from RCM Wealth Advisors over there, as well as a few forays over there at the Small Business Advocacy Council as well. He wears many hats these days, but we're glad to get him back on the program. Auntie/Federal Holiday Mike, how you doing, sir? It's been too long.
I'm doing great. We do have just a public service announcement. We've got a federal holiday coming up this Monday. Might be a correlation.
Now it makes sense. That's why you're here. Federal holiday coming up. You have to come here to announce it. That is your job here on the network. You have one goal and one goal only. You have done your duty, sir. You can leave now.
Yes, sir.
All right. And as I mentioned, we were talking about what to talk about on the program today, and it came to our attention. We were looking back, and we said, we haven't really done a deep dive into all things futures options and commodities here on the program in quite some time. And since those are top of mind for a lot of people out there, I thought we'd dive into it today with our Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody. Welcome to Options 101. As the name implies, this is the portion of the program where we break down typically some basic options, a strategy, or in this case, a product category, and explain and explore some ways that you can utilize them in your own as well as your clients' portfolios. And as I mentioned, it's been a few years since we've really done a deep dive into all things futures options over there at the program. And of course, it's been a market change in the commodity landscape since late 2014 or so, the last time we've really delved into it here on the program. And of course, crude has taken a remarkable plunge and a little bit of a rebound since then, but not as much certainly as some people would have hoped. We've seen a lot of evolutions in products like gold and silver, soybeans. We've been talking soybeans quite a bit. It's been very active over the past few months. So a lot going on. Pretty much pick your product category, and there's a lot going on out there these days, which is interesting, particularly in an area and a realm right now. We're in the broad equity markets. We're kind of got to look pretty far afield to find some volatility. The commodities can deliver in those environments. We're seeing a lot of financial advisors, a lot of CTAs really looking to take active exposure in those markets. But of course, if you're particularly a traditional long equity guy, maybe you're dipping your toe in options for the first time, the notion of some sort of futures options product, and even the term futures is, I think, scary to a lot of people, particularly if you're not a CTA. You're not coming to this from that level of understanding. So we're going to talk about some ways that you can utilize our favorite products, options here, to get some of that futures exposure, whether you want to maybe get some gold exposure for your clients, or maybe some exposure to crude oil, or some of the other many product categories out there. You can use a lot of the strategies we've touched on many times on this program in the past, in the same way for a lot of these products out here as well. So let's start maybe with some of the basics. A lot of the strategies that a lot of our advisor listeners out there are interested in on behalf of their clients are, of course, protective and also income generation. So it comes down to essentially the protective put and, of course, the covered call. Now, in this case, if you're using a futures option, you probably would already have some sort of established futures position that you're looking to hedge and or generate income on. So that's probably the starting point for a lot of people that want to have that. But we'll start there maybe with the long futures, and we'll get into maybe even some of the basics beyond there. Or actually, maybe even before we even do that, maybe we'll take a step back even further, because we can talk about one of my favorite strategies to utilize if you're scared of an underlying, perhaps, or if you just want to free up some capital in the account. Haven't really talked about this on this show in a while either. That is kind of the stock or / in this case, futures replacement strategy, which of course involves purchasing usually a mid to long term, somewhere in the 6 month plus range option out there. It could be as long as a couple of years. I know you guys in Swan love your long term options, so we can talk about that, of course, in a few minutes. Typically, in the money options are probably around a 70 plus delta out there, and buying that in lieu of purchasing the underlying. Clearly, there are demonstrable advantages when doing that with a stock, because you have a lot of margin benefits and leverage as well. On the future side, it's a little bit depends on the product you're looking at. But maybe we'll start there. Maybe Chris, we'll start with you, because you guys, like I mentioned, love your long-term options out there at Swan. Can't get enough of them. Talk to our listeners a little bit about your thoughts on, maybe we'll start in general, 10,000 foot, your thoughts on the stock / underlying / futures, call it what you will, replacement strategy as a whole, and maybe its efficacy, and maybe the way you'd like to approach it. Would you go for, that Swan approach of the kind of the 2 year out option, or maybe something a little bit differently, and how that applies to people who maybe want to use that to get some sort of exposure to a commodity product?
Yeah, I think I'll begin with saying that, sometimes a 2 year option or a 3 year option even can be somewhat intimidating to people, because people are looking at these large premiums and they're only going to the short term to hedge. A lot of this thing is going to be priced into, and what we have found is one of our mottos here is always invested, always hedged. So we are not in the business of picking tops or picking bottoms. And so when the next correction or bear market is about to happen, we're always hedged and prepared for that. So what we've noticed is holding the longer term option, there's a much better theta or time decay trade-off versus some of these shorter term options that a lot of people are going to go to. So, and our approach by having long underlying and a longer term put really has been superior to what a lot of people, most people are introduced to the collar. And unfortunately, over the years, the collar has been slowly priced out, or has gotten more and more prohibitive. And what I mean by that is prohibitive in the upside. You're starting to give up way too much upside potential for the insurance or protection that you're trying to get on the downside. So we've kind of twisted it around a little bit, and we go for, we try to maximize that theta decay and go for the longer term option versus trying to buy insurance and protection in the shorter term.
Maybe Mike, we'll also toss it to you again. You haven't been on in a while, so it'd be good to have you weigh in on this. I know you, particularly for a lot of your retail clientele, whether looking to get exposure to a futures options product in particular, or maybe just your thoughts, like Chris's kind of 10,000 foot on that stock replacement strategy in general, how you guys at RCM typically like to unfold it. Are you more in like the 6 month category? Are you more couple of years out? What kind of range do you like to execute the kind of strategy?
Yeah, I mean, to just mirror what Nick said, I mean, we'll look further out because the theta has less of an impact the further you go out. And, when you start getting to the 3 to 6 month period where theta is going to have a larger impact, we start looking at rolling back to, at least over a year on the long term, on the leap option, the ones that you hold. I guess in futures, they don't call them leaps. They just call them 2 years. But yeah, almost mirrored exactly the same. The only real, there's a few risks, right? But the biggest risk is a short-term drop, and then the market doesn't recover, and you lose everything you put up for that option. That's the only difference from like just owning the stock long-term. People are like, I'm afraid of owning something 2 years out, but they're not afraid of holding a stock portfolio for 30 years in their 401k or their IRA. When you walk them through the concept and you point out, well, you're getting leverage, you're going to get 70, 80% of the upside in the market by buying this in the money call. It's just if you get a short-term move down like quick, you have the potential of losing everything you put up. And as long as you point that out to the people, and they understand it, then it's definitely a good strategy. The more and more we do this with individuals, the more and more we'll just point them to guys like Nick, guys like Chris and Randy, where, let the professionals do it. Go out and make money, do what you do in your real job. Unless it's like a hobby and it's just a pastime, like let the professionals handle it. But for advisors, I know they want to differentiate themselves. There's ways to kind of let the professionals handle it, through mutual funds. But a lot of the clients that advisors deal with like the one-on-one attention. So understanding the strategy is important for the advisor. Tell everybody that's an advisor that's working with the client that wants the one-on-one attention of an option strategy, just to start with the risk, identify all the risks and manage the risks, and don't let the client steer the conversation to, profit potential.
Well said, sir. And Nick, you're kind of the token futures options guy here on the platform today. So you come to it from a little bit different perspective. Obviously, you do a lot on the tech side now as well with the analytics and the quick strike platform. But you come from, of course, a euro dollar options background as well. So you spend a lot of time out there in the futures options side of the fence. I'm curious your thoughts. Maybe in general, it's typically referred to as a stock replacement, but you don't hear it called a futures replacement as much. Also because futures have their own inherent margin benefits as well. But I'm curious about your thoughts on this strategy for a lot of advisors out there, and also maybe your thoughts in general. I haven't had a chance to ask you really your thoughts in general on a lot of advisors on the equity side of the space, maybe starting to dip their toes into the commodity realm and using futures options to do that.
Yeah, first off, I want to clarify, Chris gave that excellent answer earlier. This is Nick now talking. So
yeah,
he
said Nick, but we knew who he meant.
It's Chris. My voice is more sultry, maybe, but that was Chris to go first.
I think
my initial reaction is when I hear it, and again, Mark pointed out, I'm more technical than I am practical at this point, but I still, I'm keeping an eye on things and I'm talking to a lot of customers and that type of stuff. When I hear a deep in the money call, most of the time I get a little bit scared about what I'm going to pay in, that call has parity associated with it, but it also has the value of the put or the out of the money or the value of the out of the money call incorporated in that pricing. So my initial fear is like, boy, that's a lot of extra stuff to pay for me to get along that market synthetically, so to speak. But Chris makes a good point, and I was in Quick Strike just taking a look. When you start to go out a couple of years, your theta as a percent of premium is absolutely negligible. So it becomes and looks like a really good idea just from, again, I'm looking at it sort of from a practical numeric standpoint. It looks like even better idea. And when you start to go out to the 25 delta put range or the 75 delta call, the amount that you lose on a day-to-day basis is basically nothing. And then we also have a number in there that we calculate. We call it the theta vega. And I think Cavs mentioned about the movement and a sharp movement in the underlying. The amount of vega that you need to replace the theta lost in a long-term option. Like if you have a move down, even if the move's down, the vol is going to go up in those options. So you may very well replace your theta that you're going to lose very easily with an increase in volatility. So from that standpoint, it seems and appears to be a pretty good replacement strategy. As far as advisors starting to use options in place of underlyings, it obviously makes sense just from a margin standpoint and even from a flexibility standpoint. You can start to structure your positions or your resulting positions a lot more intricately than you could just with a long or short upright. So I think you're going to, as everybody's already doing, you're going to see that more and more outside of just protection or premium enhancement or alpha enhancement by selling the upside. So, that's how it looks from my side.
And, we should mention, too, here, when we're getting into the replacement, but a lot of the strategies we talk about a lot here on this program are also very applicable in the futures option side of the fence. So if you want to, let's say, WTI, very popular product these days, which is, of course, crude oil options. You can, of course, look at the future. Of course, you can look at options, let's say WTI, hovering as we're recording this in the mid-40 handle or so range right about now. Let's say you had an outlook, it's going to rally north of 50 sometime in the next few months. You can, of course, use options to spec either as an outright buy of the 50 call, or as we like to advocate more here, some sort of vertical type spread to offset some of that premium you're paying. And all those strategies you talked about here, verticals and things like that, all still work in the futures option side of the fence. The only real caveat to be aware of there and cognizant of is, of course, the underlying is different. When you're looking at a stock, you have essentially one underlying for all of the options. It's just the stock. It doesn't change, it doesn't go away, it doesn't expire. When you're talking futures options, it gets a little bit more opaque sometimes with which option is trading off of which future, and that could be sometimes a cause for concern. We'll get inquiries all the time, not just from advisors, but from basic retail and others who are starting to dip their toes into futures options, and they're confused about why this option seems to be mispriced. And we usually have to walk them through it's actually pricing off this future, not this future. And so that takes a little bit of knowledge of your particular product. So that's probably the good starting point for anyone. If you are going to dip your toes, I should say, into the futures options, well, then a good knowledge, a good basic understanding of your contract specs and your products. WTI is a good example. Very active, very liquid. We kind of have to know the nuances of that product. It'll go a long way. And then, of course, you can always advance to some of the more advanced spreads we always talk about on this program here as well, the quote-unquote spreads with wings. These are, of course, great for, Nick was talking about volatility exposure earlier, for volatility exposure in a lot of different products. So whether it's your proverbial iron condor or your iron butterfly, you can still come in and price up and execute these just as you would in a traditional equity option. The other note I would put out there, main primary difference, in addition to the nuances of the underlying from a futures options perspective and the fact that the future obviously has an expiration date, whereas the stock doesn't. But the other primary difference you're really going to notice out there from a practical trading perspective when you're trading futures options versus equity and index options is indeed the volatility skew. That's where one of the biggest changes are. In fact, Nick and I talk about this on pretty much an ongoing basis every week on This Week in Futures Options, because volatility skew is such a fluid thing in the commodity space. When we're talking equity products like S&P or even big equities like Apple or what have you, Google, whatever, they all exhibit similar skew shapes, which is typically what's called an investment skew, which is, of course, the puts have a higher premium from an implied volatility perspective to the calls. And that's the way 99.9% of equity and index products are shaped. The slope may vary, but the shape is pretty much going to be always that shape. In the commodity landscape, it's a completely different ballgame. WTI exhibits a strong premium to the puts right now, and the calls are very weak, but gold is more of a smile shape. The puts and calls are kind of equally skewed. In fact, the calls seem to be catching up a little bit and leading the charge these days. So you see a lot of different evolutions. Soybeans had a very rich bid to the calls. The puts were very cheap, so it actually lined up very favorably for callers, buying cheap puts, selling very expensive calls. So that is certainly another nuance of your product you have to become aware of and familiarize yourself with before you dive into the futures options. Well, and also, it's not something you can come and do once. As we've said on TWIFO many times, the skews will evolve week to week. I mean, Nick, probably gold is a good example. How many times have you and I chatted about gold, and that skew is all over the place? The calls are expensive, the puts are expensive. That obviously, that shape of the volatility skew is going to impact how traditional strategies like a covered call are going to play out. If the calls are very, very rich from a volatility premium perspective, guess what? It's pretty favorable for covered calls. If not so much, and vice versa. So it's a lot of interesting stuff out there. Maybe, Nick, if you have some thoughts, because this is obviously a topic we talk about a lot on our program, and is interesting to a lot of the financial advisors out there as well. Maybe your thoughts on the evolution and the evolving nature, really, of volatility skew, how fluid it is in the commodity space versus the equity space, as well as how that may impact some of the traditional advisor-oriented strategies, the covered call, the protective put, and the collar kind of being the three biggest.
Yeah, well, Mark, even since we started doing our show, we saw exactly what you talked about in the beans, where we had the big run toward the upside, and we saw the skew really take a turn on that side. And with our last show that we did, we see that is completely reversed, or has basically gone from a crooked smile, from a top right slashing down to the bottom left, to just a regular full smile. So, the important thing is that you keep an eye on it, and as Mark mentioned, it tends to go back to its sort of normal shape and size, or it will fluctuate back and forth depending on what the market has to see for that particular commodity. Mark mentions the gold as an example. I'm looking at our quick skew chart right now, which is sort of measures the richness or cheapness of the calls to the puts. And back in the beginning of this year to late last year, we had the puts were at a premium, much higher premium to the at the money, as well as the calls being at a credit to the at the money from a volatility perspective. And that has switched back and forth multiple times over the last 8 months, and maybe not have crossed each other's path like they did back in the beginning of the year. But we definitely saw sort of, the amplitudes changing both on the upside and the downside, where one was more rich or cheap to the other. Now, the point of all that thing is that you can watch these things and you can start to make smart bets in terms of how you're going to cover, right? So you might be able to finance with a rich call and cover with a cheap put, or you might be able to, gain some premium by selling a call and buying the put at the same time, right, with the collar. So you can get some protection. You can finance some protection. You maybe even get a credit with something that's a little rich. Or if you want to protect your portfolio in general with volatility, you start to look at the skew of the calls and the puts, the calls that are both on the downside, a 15 versus a 25 delta. So you start to see which one you might want to buy and which one you might want to sell. So the idea there is to just keep an eye on things, because it tends to sort of revert back to its mean, as we hear all the time. But there are definitely trading opportunities within your covering, hedging, and alpha increasing opportunities as well.
And Chris, same question for you, kind of your thoughts just in general. Obviously, volatility skew is a big factor you guys watch out there at Swan, because you're always looking mostly on the index side for how that's shaping up. And so you don't really have a different shape so much as a different slope to that skew, which is always, of course, I'm sure, of interest and concern to you, for paying for puts versus paying for selling calls, and all the different nuances therein in terms of how much premium you have to pay for one, how much you can collect for each. But maybe your thoughts on the impact of the ever-evolving nature of volatility skew for your proverbial financial advisor out there who's maybe thinking about dipping his toes into some of the big commodity options out there, like, let's say, a WTI or perhaps a gold option, something along those lines. But as Nick was just saying, it is a very fluid landscape. Maybe some thoughts on how that evolving nature of volatility skew can really impact your option strategies.
Well, it can have a huge impact. I mean, you can go all the way back to 1987 before the crash. There really was no skew. And I think very few traders even knew the word Vega back then. So you've had this, we trade supply side products, like you mentioned. So, if companies need more equity, they just issue more stock or more debt, what have you. So you have the supply side skew, which is downward sloping, as opposed to commodities, which are demand side products. And, the skew moves around. Everyone talks about the VIX, which is absolute volatility for the most part, moving up and down. But skew is like a pivot. It's going to anchor around the at the money and get steeper or less steep depending upon underlying movements. So typically, as underlyings rally, like right now, you're going to get a steeper skew. And right now, in fact, in the SPX, you'll notice, like, if you take a 10% out of the money put and compare that to a 10% out of the money call, that relationship is very steep right now. And a lot of people talk about, well, what percentile is that in? So, over the last 2, 4, 5 years, it's actually very expensive right now to buy the downside put versus selling an upside call, which is your traditional caller. So, and you'll see that, if the underlyings, or if the market starts to go down, then skew has a tendency, depends on the speed of that movement, it'll have a tendency to flatten out, right? People are starting to sell their puts and then buy upside calls for a bounce. So it is something that we have to monitor, and there are a lot of different strategies to take advantage of when skew is rich or when skew is cheap per se. So, but for the most part, over the last few years, especially with this central bank induced rally that we've had over, during the second longest bull market, upside calls for the most part are fairly priced, if not maybe even slightly underpriced. And you're seeing people reach for protection because, we all remember the financial crisis. We all remember the volatility of 2011. And I don't think people want to be burned out there. So insurance, is needed for people who have portfolios, like was mentioned earlier. People are willing to hold stock for 30 years, but they have to start thinking about, well, it's okay to hold options as well for a longer period of time than just the short-term nature that, we've been kind of taught since options have been around.
So for Chris, do you guys ever show or plot for customers the deep in the money versus the stock outright and show them how it's performed over an extended period of time? Because I just know my first reaction, just being familiar with options, I'm always thinking I'm going to, it's a decreasing asset, right? You're going to lose money because it's insurance. It's not the outright. Have you ever done that? And what kind of reaction have you gotten if you have? Because I know just from talking to people over at the CME, when they're dealing with even the producers like the farmers and stuff like that, they're always leery of the fact that they're paying for something. They're paying for more insurance where they're not going to get anything out of it in the long run.
That's a great point, Nick. We are paying for insurance in the long run, long-term insurance per se, but what we're trying to do is fund that with income-generating strategies. So we're selling short-term insurance against that. And, as Mark mentioned earlier, monitoring the skew and where volatility is and the term structure between the months in the shorter time space is really important to our strategy so that we can offset that cost, the cost that of 2-year insurance or 3-year insurance or 1-year insurance, whatever the case may be. So timing the skew, timing the raw volatility, timing the term structure movements are very important to our strategy so that we can reduce the overall impact of that long-term insurance.
And Auntie Mike / Federal Holiday Mike, if you want to know the origins of those nicknames, check out the archives of our option block program from a few years back. But I'd be curious your thoughts on this as well. If you want to chime in on the volatility skew conversation, you certainly can. But also maybe I know a lot of our advisor audience out there is thinking to themselves as they're listening to this program, they're saying, well, WTI and gold are good, options are good, but I like my GLD and my USO. Why can't I use options on those? And you certainly can, but there are indeed some caveats. I'd also maybe like your thoughts on that. How do you guys over there at RCM, how do you typically steer your retail clients as well as other advisors that you're talking to when it comes to which product you think is suitable, as well as, of course, if you have some thoughts on the evolving nature of commodity skew and how it impacts strategies, have at it, sir.
Yeah, no, WTI, we just say WTF, right? That's we just throw our hands up. No, really good points that both Nick and Chris made. I kind of go back to thinking about like knowing your client and then knowing your capabilities as the advisor. If you don't know what a volatility skew is, there's a good chance that you probably shouldn't be the one executing the trades for the client. So before you even dive into where you want to be on the skew and how to read the skew, short term, long term, I think it's just understanding that you have to define what your goal for the strategy is and then what your edge is. Typically, when we're working with our investors, we're not trading, right? We don't have high frequency prop trading desks running, high freak algos that are, trying to pick off different ways to make money in the market. We're defining our edge by we want to determine how much of the market we want to be long, whether it's a deep in the money call or an outright stock. And then our edge becomes the time that we commit to the position. And generally, if we're long and underlying, whether it's just outright long the stock or outright long the futures contract or a deep in the money call, our edge is the time decay in the call option that we sell. And we're not as concerned about the short term, about the relationship between, puts and calls on the skew as much as in the commodity world. In the equity world, we're more concerned that we understand the risks of the position, the outcome if the market goes down, the outcome if the market goes up, and the outcome if the market stays flat. All good points, but if your clients are asking about skew, then you might want to take that to the professionals that have the time to sit on the trade desk and tackle those kind of trades. Most advisors I meet aren't going to be the advisors that are going to dig in the weeds and teach themselves skew. It's good to have an understanding, so you know what to look for, but actually sitting there and trading it, I know few advisors that do that, and the ones that do are, the guys like Randy and Chris that have a program for it. As far as the second question, when do you use GLD or when do you use gold? When do you use like an oil ETF or the actual real underlying? I think it just comes down in the advisor world. It just comes down to knowing your customer. A lot of times, the pure product is going to be the futures product than the ETF, because there's going to be something within that ETF that it's trying to copy the movement, and that's never 100%. But they've gotten pretty good at indexing the different things. Occasionally there's a hiccup. A lot of times it just comes down to the entry barrier on the ETF options are a little lower generally. You don't have to open a separate account generally. A lot of firms now do have like joint equity futures accounts, like the Interactive Brokers, the Schwabs, where you can open a futures account within an equity account. And if you're the advisor, that's easy. And if the client's really interested in futures, you get a better, cleaner, pure look at the movement in the underlying. But access to capital, like the smaller incremental cash outlay on the ETFs, it tends to be a little bit lower. So there might be a slight lean for the beginner to be in an ETF option. And the fact of, where you're holding your clients' accounts, if they don't let you trade futures, then you're probably just going to lean more towards the ETF options.
Yeah, I know it's certainly a big chunk of the audience out there that still likes themselves some GLD and some USO. I mean, I can certainly understand a lot of that, and you're right, it does have to do with your clientele and what they're comfortable with. Certain ETFs offer better proxies than others. Obviously, I don't really have much of a problem with GLD. They hold the physical, so they're allowed to do an end run around some of those problems, I should say, that tend to plague other products that attempt to replicate some sort of long futures position, either with a basket or some sort of ongoing roll or things like that. And that's when issues tend to come to pass, and the roll yield tends to negatively impact those products. So I tend to lead more towards the pure exposure. If you want that pure exposure in crude, then go to like a WTI, or if you want gold, then go to the gold options. So there certainly is the purity nature there. You don't have to deal with the roll issues that are inherent in a lot of commodity ETFs out there, and they all handle it different ways, some much better than others. But in general, if you want the pure exposure, it always is good to go to the pure product itself, even if that is maybe intimidating for some of the advisors out there. I don't want to end our conversation on futures options without at least touching on another aspect of the space that has gotten I know a lot of advisors out there excited and interested, even though there's futures and there's options on the futures, even though they're technically cash settled. So you're not really, and I'm talking, of course, before I get ahead of myself, about volatility, aka the VIX. That is a place where a lot of people are interested. A lot of advisors are interested because their clients are interested. And those are technically in the futures option space as well, even though, again, you don't get a truck of VIXs doesn't pull up to your house when they expire. You get cash, so it's a little bit different there. But aside from that, you still have to deal with a lot of the same nuances in terms of the term structure, in terms of what we were talking about earlier with the options keying off of different futures. So you have front month keying off of one future, 3 months out options keying off a different future. In fact, if there's still one, I'm not sure if it's the number one anymore, but it's still somewhere in the top 5 of the questions we get here at the Options Insider on their website, through the radio, whatever the case may be. It is still, hey, I'm looking at VIX cash, and my options are printing here. Why is there some discrepancy in this? Because they don't understand that the VIX cash is not where the options trade, not priced off of that. So that's still one of our biggest and one of the more confusing aspects of these products. But of course, VIX products and volatility in general are attractive because they give you exposure to what is still one of the assets that has the best negative correlation out there, which is volatility. Depending on where you look, somewhere in the 70 to 80% roughly negatively correlated to the S&P. That's obviously attractive for a lot of advisors out there who are interested in hedging out there. So, Chris, you guys, I know you tend to play more in the pure S&P products. So you like to go out there with your SPX and your SPYs and your big futures options you than the implied volatility of S&P, which is the VIX. But still, I know you're cognizant of that, and you watch that on a lot of areas. And maybe you guys are evolving there. Maybe you're looking to dive into some of the VIX products a little bit. So I'd be curious your thoughts for the typical advisor out there, maybe the suitability of some of the VIX products out there. Would you prefer to see them maybe perhaps just going straight for direct S&P volatility and getting their, let's say, the old debate of the S&P put versus the VIX call? Which way do you lean on that? I think I have a feeling which way you lean, but I'd like to hear it from you. And also your thoughts on, again, just these products and their natures and their maybe suitability for the advisor audience out there.
Yeah, I think one of the words you've used today is understand the nuances of your product. The Olympics just ended and they announced the winners in French. Why? Because French is the international language of the world, or according to the Olympic Committee. VIX happens to be the international language of volatility, but you can't really trade the VIX per se, right? It's a 30 calendar day strip of options, so it doesn't exist. And I think what everyone has been so programmed to watch the VIX, talk about the VIX, well, because that is a common language when you're talking about volatility. Now, options are priced off the forward, right? And the forward is the future. So people who are looking at spot VIX, right? Cash VIX, and they're wondering why their options didn't behave a certain way. Well, they're not being priced off spot VIX. They're being priced off that forward or that future. So, if you're an advisor and you're getting into this volatility game, the very first thing you have to understand is that it trades off of a future. And again, you have to be cognizant about that term structure because it will move around. Another challenge that's been happening with the landscape here is that you've got all kinds of volatility ETNs and ETPs, and they have to rebalance their Vega book as markets move up and markets move down. So I think what's been happening is that you're seeing really big swings in the volatility of VIX, right? The VVIX. So you're seeing much larger maneuvers with cash VIX, but not necessarily so much in the futures. Okay, and that's the issue. That's the problem. Is like longer term futures aren't going to be susceptible to that kind of movement as the shorter term cash VIX is. If you really want exposure to cash VIX, I think the best way is to stick to SPX options, Standard & Poor's 500 options. That's really the purest way as far as trying to trade that on an exchange. Unless you have the ability to do some type of variance swap or over the counter type product, but VIX is still priced off S&P 500 options. It's not, it's not. And the options, however, on the VIX is priced off the future. So you have to be, it's a big circle that you're going in here, right? You're pricing a derivative of a derivative of a derivative. So again, you have to be very careful about doing that. We're always looking at the term structure. Again, we have options, positions in different maturities. So knowing where the VIX term structure is very important because that's going to be very representative of where the option term structure is as well. So those are things that we have to monitor and see, making sure that they're not out of whack and they remain in line for our positions as we manage them throughout the year.
That's a good point you bring up about the exploding universe of ETNs or just ETPs really in the VIX and volatility landscape. I mean, if there's been a secret sauce really for the success of VIX, it's just the explosion of those products. There is an ETP or an ETN out there for pretty much any flavor of volatility that you want. If you want 2x short or 3x long or some sort of other weird ratio, mid-year, long-term, short-term, it's out there. And as you're right, they all have a challenge when it comes to how often they rebalance, how well they replicate the underlying or the product that they're purporting to deliver. So there's a huge universe out there. Not a lot of those products I would actually recommend on a regular basis. One of the more popular ones, of course, VXX is the one a lot of people like to use, and one of the highest volume products out there on exchange traded volume on any given day. And yet that's a very, very short-term speculative instrument. I wouldn't recommend anyone hold that longer than 24 hours probably. In fact, they even mention that now in some of their own prospectuses and things. So they're starting to realize that issue themselves. And that goes back to what you're talking about, Chris, that rebalancing effect and the negative roll yield that keeps impacting that product. I've seen studies that go anywhere from 4 to 15% a month, depending on the slope, of the term structure of the VIX futures, how bad that product is disenfranchised by that. So if you don't want a product that's eroding anywhere from 4 to 15% a month, that's just not something you want to put in your IRA and set and forget for a couple of years. So yeah, it's definitely a challenge. Mike, maybe a similar thought process then for you, talking before about the universe of different ETFs that are available out there. People who want to trade commodities. The same certainly holds true for volatility and VIX. So when you're talking to other advisors out there, I know you talk to a lot of advisors over there at RC. I mean, you're not just out there managing clients and talking to clients. You also talk to a lot of advisors out there. I'm curious what you recommend to them when they come to you, as I'm sure a lot of them do, saying, "Hey, should I mess with these VIX options things, or should I touch VXX or some of these other things?" So maybe how do you counsel them first in general, just on their approach? Do you tell them to avoid VIX or maybe go for it? And then B, if you do, which way do you counsel them? Kind of the mothership pure products? Are you more into some of these? Do you have a couple ETPs that catch your eye, or what's your preferred use case?
Go to Vegas. The drinks are free, and the women are way better looking than me. I mean, it's flattering when people think, that we can advise them on the VIX. I send them to the professionals, guys like Chris that were on the floor, that were at the big shops, that are professional options traders, that can cross-analyze markets and understand the relationship between the VIX, the S&P, the foreign markets, why the VIX is moving. Those are all the things that go into the monitoring, even if you're in one of the ETNs or the ETPs. If you're using that to hedge your stock portfolio, your long-term stock portfolio, and you're the advisor giving the advice to the client, why are you subjecting yourself to that? I'm a firm believer that vanilla options are the best thing for an advisor, to just straight vanilla, like car insurance. You pay a monthly premium, kind of look at an S&P put option on a long-term portfolio as a vanilla hedge that is pretty easy to monitor and pretty easy to understand and explain to your client. When you start getting into the more advanced hedging, and there's great firms out there that can do it, when you get into the VIX, it's kind of like apples and oranges. Why subject yourself to that? There are people way smarter than me that are running algorithms. We're getting into the artificial intelligence algorithms where they're trying to use predictive analysis to start trading this stuff. That's what you're up against if you're trying to trade something that isn't the direct correlation to your underlying. So VIX is an asset class. VIX is a tail risk. Like I don't use it. I don't advise people to use it. If somebody's really interested in it, it's usually really smart money, like family office, hedge fund kind of stuff. Most of the stuff that we talk to in the retail world, 5 billion and below, they aren't active using the VIX to hedge portfolios.
We covered a lot of ground here on our futures options 101 here today, just to kind of maybe wrap it up here in terms of a summary. All the different things we talked about. Futures shouldn't be a scary thing, and certainly options on futures shouldn't be scary to a lot of advisors out there who are interested in perhaps getting some of that exposure to those products for their clients. Of course, there are some ETFs, as we touched on, out there, but I think a lot of us here tend to prefer the pure thing that you're going for at the end of the day. So if you want oil, maybe WTI as opposed to USO. If you want gold, maybe gold options as opposed to GLD, even though that latter one I could see an argument for. And of course, we even touched on volatility, which is always an interesting area. We could touch on that for many, many more episodes. And again, at the end of the day, if your clients want this kind of exposure, futures options are indeed a viable source. Don't get hung up on the futures component, really. So many, as Mike mentioned, so many brokers and firms these days make it so easy to kind of cross and bridge that divide now between equities and futures. It used to be that there were two separate accounts, and it was very, very difficult to bridge those. Now there still are separate accounts, but they've made the front interface portion for you, the advisor, and indeed for your clients, so straightforward. A lot of times they appear as almost the same account for you from an execution and an activity perspective. So that makes it a lot easier. Fill out a few forms, and then pretty much that bridge, that gulf, is nowhere near as broad and as scary as it once was just a few years ago. So if that's your main holdup, that is certainly an area that has been addressed by a lot of firms. They've heard your complaints, and they've acted on that account. And of course, no matter how you like to embrace futures options for your clients, we certainly recommend that you utilize the strategies we've advocated on this program from episode 1. Those are the risk mitigated strategies. So instead of just buying a call and hoping for the best, maybe a vertical instead. Spreads that tend to spread that risk out, pun intended, and also mitigate your client's outlay and also mitigate your risk at the end of the day, which is the way we prefer people to utilize these products, not getting out and getting short a bunch of units and then having to deal with all the intended and perhaps unintended consequences therein. All right, we talked a lot about futures options. I do want to get a really quick the buzz segment in because there's a few things that have been going on that are worthy of note. So without further ado, let's do it. Let's dive right on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. Like the man said, this is the portion of the show where we break down some of the interesting developments in the world of options, and indeed that pertain directly to you, the financial advisors out there. This one's kind of an interesting one. It kind of touches on a core tenet of the advisor space that advisors have been taught for years. Some of the more active ones who listen to a program like this have certainly probably migrated away from it in recent years. But there's been this core foundation for a lot of accounts out there. This whole 60-40 kind of breakdown was the way the responsible quote-unquote advisor was supposed to approach it. 60% equities, 40% bonds, and then you were doing your due diligence for your clients. Well, of course, we here on this program advocate a much more active approach, which involves probably differing a little bit from that traditional 60-40. But it seems like collectively in the industry has been a lot of pushback very recently against this whole 60-40 approach to investing. And a lot of different outlets I've seen conferences and keynotes about this topic and discussing how it very much underserves the needs of the clients. You guys as well, Chris, over there at Swan, you had a big write up on it in your blog recently. And I thought you guys had a good point, and maybe we'll link to the blog in here. So you got a great graphic. But effectively, if you do that 60-40 traditional split that you have there, and you just run some basic math, and people want to get somewhere in their average return, somewhere around 8% a year, let's say, which is a good target return for an equity portfolio. If you have that 40% in fixed income, you're not going to make a lot. Let's say you make around 2%. Well, guess what? That 60% now has really got to turn up the juice to generate that net 8%. So if you want that overall return, again, you need about 12% a year out of your equities in order to make up for that underperforming component of the fixed income, which, it sounds basic and intuitive, yet for whatever reason, this has been kind of the gold standard for advisors for so long. And thankfully, a lot of people are kind of waking up to the fact that this probably doesn't really serve the needs of a lot of clients very well. Chris, I'm curious, since you guys at Swan have been discussing this and breaking it down over there quite a bit, your thoughts on this whole 60-40 rule and perhaps its efficacy or lack thereof here for the modern financial advisor.
Yeah, I think advisors need to start thinking about breaking away from the Markowitz theory and capital asset pricing model, because the traditional 60-40, as you mentioned with the numbers, just is simply not working the way it used to be. I mean, if you had actuarial demands of 6, 7, or 8%, that would have worked now. But now, as you can see with with the yields on fixed income products today, I mean, now you have to get a whopping 12% on your equities just to get that 8%. So, I mean, how many people out there think that you're going to get 12% in equities year in and year out? I don't think too many people are going to be raising their hands anymore. So it's really, people have to rethink this mix, and when you're thinking about 60-40 portfolios, the one thing you have to always consider is correlations as well. What's the correlation between equity and fixed income? What's the correlation? We talked a lot about commodities here, and commodities are another way to diversify portfolio, because you can find commodities that have a tendency to have less correlations. Like gold recently has a negative correlation over the last month or so, but unfortunately, when the markets start going down, what happens to correlations? They all start to go to 1. So it's really it's getting more challenging for people to follow traditional portfolio metrics and to diversify themselves. And so that's why the approach that we've taken at Swan when we manage our portfolios is going into the options market to truly get or acquire an asset that does have negative correlation to your overall book or portfolio. So again, just to sum up, it's just a matter of, if you're restructuring a portfolio and you're sticking to that traditional 60-40, you need to give it a second thought about, is that 60-40 going to, is it going to act in the future as it has the last 4 or 5 decades? Because, the industry changes. I mean, this is the one thing about the financial markets, is they are constantly evolving. What trade worked 20 years ago on the floor doesn't work anymore upstairs. And what works today may not work tomorrow. But so you have to have strategies that can, go through the test of time and that are truly correlated, such as what we have at Swan.
Well said, sir. Mike, I guess we'll wrap up this the buzz segment with you. I know this kind of hits home for you guys as well. You guys clearly at RCM are in the more active categories. I think you've been beyond the 60-40 split for a long time. But that said, what are your thoughts out there for the advisors that are still maybe clinging to this somewhat outdated maxim as a guiding principle for how they manage their clients' money? And are you starting to see this as well? Are you starting to see an evolution from a lot of advisors who just realize, if they just stick to this, they're really they're not going to perform well for their clients, and B, they may actually lose those clients over time to another advisor who is doing some of the more active approaches like what we advocate on a program like this?
Yeah, absolutely. I mean, it's always been a demand, client demand driven market investments. A lot of advisors don't want to suggest, hey, let's get into futures or alternatives, because if they move them out of something that's deemed traditional, and they don't do as well as they could have, then they're wrong and they run the risk of potentially losing a client. In the past, 60-40 worked. You're 60, whether you were 60 in stock, 60 stock, 40 bonds, that was working. Bonds 10 years ago, the risk-free rate was 4.5%. With munis and corporates paying a little bit more. It worked. So the clients were happy. Their toughest decisions were, are we going to the mall or the country club today? And they weren't calling their advisors upset about the yields that were being kicked out with their portfolio. Now you are starting to see the client demand driven market of, how come I'm not at the mall or the country club? How come my portfolio is not yielding what it was? What's going on? I was talking to my neighbor and he's in this alternative strategy and he seems to be fine. What's going on? That's starting to happen. And when it does, it's probably there's a way to be more proactive as an advisor, but it's definitely a time to be educated. If your red flags and sensors aren't going off as an advisor right now on multiple fronts, not just with the 60/40, but like even the robo advisor stuff, like your bells and whistles should be going off to where you're looking at all the different things that have changed. And when the calls start coming in from the clients, like, hey, maybe it's time to look at something outside of 60/40, you'll be informed. You'll be able to say, hey, I have some other clients in this. I'm educated on it. I think we should do this. It's definitely happening. It's not the clients are coming out. I mean, you can see like hints of everything out there that have changed in the market. Not completely correlated, but I've seen wealth advisor firms now have the FINRA broker check right on their website. 10 years ago, I don't even think most advisors knew about FINRA broker check. Now they're putting it on their website. It's a way to build trust, show transparency. The more that you can do things like that, keep yourself educated, learn these strategies, so when those calls come in, that you're prepared to take them. So, yeah, it's nothing. Shouldn't be anything earth-shattering to an advisor that, if you're not thinking of the best scenarios for the client, somebody else will, and they might see a commercial, they might get a call from another advisory firm. So, it's definitely something you want to educate yourself on.
All right, that's going to do it for the Buzz segment. It's also going to do it for this episode of The Advisor's Option. But before we go, let me check back with each of my cohorts here on the panel. Great discussion today, very wide-ranging on a lot of different topics and a lot of different products out there. But before we go, let's bring back each of them. Nick, let's start with you, sir. Glad you can join us and bring your futures options expertise to the table here today. And before we go, of course, tell our listeners a little bit about what it is you do over there with a little product we like to call Quick Strike.
Well, thanks again. Appreciate being part of the discussion. As always, if you want to learn more about Quick Strike, we always point you over to the CME Group website. And if you search for Quick Strike, QUIKSTRIKE, and click on that first link in the search drop-down box, you'll see all of the free tools for futures options pricing and analysis that are available out there for your consumption. If you ever have any questions, please feel free to just shoot us a note via support, but always point people to the vast array of tools that are out there already. And if you need something more, give us a call, and we probably have something in our subscription package.
Mike, same question for you. What's cooking in the land of all things RCM Wealth Advisors?
Yeah, we're just plugging along. We had new clients. Still have a lot of growth and focus in the corporate world, like dealing with corporate retirement plans, 401ks. Probably the biggest news on our horizon is we're moving on up in the world. We're moving into a new office here in Chicago, October 1st. So we're about a month away from moving closer to the financial district. So we're in Printers Row now. We're going to be at right across from the Willis Tower, formerly known as the Sears Tower, formerly known as the artist called Prince. We'll be at 318 West Adams starting October 1st. So that's our big news.
Oh, you're coming in our neck of the woods pretty soon. Getting close to the West Loop. You can walk on into the old studio, do the shows live. That'd be fun.
There you go. Yeah, moving back to the Loop.
Getting back to where the action is. Glad to hear it, sir. And, of course, our friends over there at the OIC couldn't join us today, but if you want to learn more about what they have to offer for you, the financial advisor, head on over to optionseducation.org. Click on the Advisor tab, and that will take you right to all of their great information. You got to log in, but once you get past that, there's a lot of great studies and info that you can really arm yourselves with if you're talking to your clients about options. They give you the data to do that, which is always very helpful. And last but certainly not least, Chris, you guys at Swan over there, you've been pretty busy. In addition, you had the big conference, the big summit down there in Puerto Rico a couple months ago. I was glad to be a part of that and really see a lot of the advisors up close and in person and talk to them about options, which was always fascinating. You and I sat down there and had a great chat down there. I know you guys have been doing a lot of smaller events. You were just in Chicago a few weeks ago for some more advisor-oriented education type events. So maybe you can tell our listeners a little bit about what you have coming up on that front. And also, listeners, if you're interested in that write-up they had about the 60/40 over there, the Swan article is called the 60/40 Portfolio. If it's broken, then fix it. Search for that. We'll also put a link in the show notes so you can read all the great charts and graphs. We only had a time to kind of scratch the surface here on the program, but you can read more over there on the site. So, Chris, what's cooking in the land of Swan, and what's going on with the upcoming educational events?
Yeah, well, you're right. I know you came down here for the conference that we had in Puerto Rico. So we kind of spun that off for other venues, and we're going out and traveling across the country and meeting with advisors and giving them really a forum to speak with our portfolio managers and kind of, pick our brains in what we do and how we construct and manage our strategies. So we've had a really good reception around the country, and I think you can go to our website and see where we're going to be next if it's somewhere near you. And if you want to come out and meet our portfolio managers and kind of see what we do and how we manage our stuff. And, again, we're always invested, always hedged, so we're going to keep hitting the pavement out there.
Yeah, you can learn more over there at swanglobalinvestments.com. And on behalf of Chris and good old Auntie Mike and Nick, who is nicknameless, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course sending in such great questions. You're going to get a chance to get to them this week. We'll get to them on the next episode, don't worry. And we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.